All right, we're gonna get started. So today's presentation is on stocks and bonds. Just a reminder, I'm Claire, the Vice President. Yeah, it's gonna be a quick little fun workshop, just to get you guys more familiar with stocks and bonds. So a lot of you probably came to our last mini workshop and we went over saving versus investing, time value of money, power of compounding, when to invest, and importance of diversification. So this is just gonna take it a step further because we're saying, you invest in stocks and bonds, but what are they fundamentally? So yeah, stocks. So does anyone want to give any input what they know about stocks? Take a little moment, talking to your groups, and maybe we'll come back. So anyone want to share what they said in their groups? Yeah.
So what we said was it's basically buying a share of a company, and it's basically you have the money, but it's again not really a liability because you can go ahead and sell the stocks whenever you want to, depending on what this economic situation is. So it's definitely an asset when you have it, but then again, there's no liability as taxes or any other such one.
For sure. Yeah, that's great. Anyone else? Yes.
I was saying how I know there's a lot of numbers associated with stocks and so many things to watch, but I don't really know what the numbers and different ratios mean.
Yeah, so yeah, there's if you look on Yahoo Finance, so we're gonna go over this tomorrow, that workshop. So we're gonna be looking at PE ratio, what do these mean? And there are a lot of numbers, but you just gotta go with what you're interested in at the end of the day, what companies you find interesting, investing in Lululemon because I love Lululemon, you know what I mean? What it also goes with values, not just numbers. So yeah, anything else? All right. So I'll get into more of the definition. So we have a stock, which is a type of investment that represents a little ownership of the company. And that ownership of the company is your share, so your fractional ownership of the public company, corporation, in proportion to the total number of shares. So you might buy 100 shares of a company, but there's a million shares, you know what I mean? So we're kind of using this piece of cake to represent you own such a small sliver of the company of your share, in terms of everyone else who owns X amount of number of shares of a stock, if that makes sense. So you're kind of cutting a little piece of the pie and you're earning and then whatever the investment makes, that's what you're getting out of it. So it's where do you even buy and sell stocks? So that would be stock exchanges. So you guys probably know Wall Street, it's New York Stock Exchange and NASDAQ. So it's the TVs with all the numbers that are going that. Those places are going to have the information and then you can buy them through there. And then also different apps that you can buy that makes it super easy, and then we'll get to that tomorrow too. And then we have IPO, which is initial public offering. So when a company goes public for the first time, allowing people to buy shares shares of their company. This is when people buy the stock when they first go public. And then dividends. So your shareholders, you'll own a little bit of profit depending on how much, how many shares you have. And then a lot of companies will release dividends, typically quarterly, of in proportion to your shares of stock and their profit and how much they allocate for dividends. You're gonna get some of that money that they're getting too. That makes sense. That was kind of a lot of information thrown at you. So any questions on this page? No? Okay. So we have more. So corporations issue and sell stocks to raise funds to operate their business. So you're initially paying money to buy a stock, right? So and then over time you'll earn you'll earn money through that investment. So that's what you're getting out of the company, but what the company is getting out of you is like you're giving them money to perform well. And then there's two types of stocks. So you have common stock. So that's gonna be like you have a right to vote, you have a stake in the game, and you get like a better return on investment versus like a preferred stock. There's no right to vote, you're just like kind of there. And then you do get paid first. So like a lot of people like choose like common stock because you have some sort of stake in the game. Like you really want the company to do well. So like your inputs like affect the company in somehow, like your opinions on the company and what they should do. So stocks come in like a variety of different ways. So different sizes or large stocks like mid, small, micro cap. And then there are types like you got growth, you got income, value, blue chip. Like there's just like so many like different types of stocks that you can like research a company and like that's like gonna be like all online because there's so many, like you can't just give like a definition for each almost. So like when you're doing your research to see like which one you're gonna invest in, like see what type of stocks are out there. And then like literally why do people like buy stocks? It's like throughout history, they've outperformed almost every like any other investment over the long run as the stock market averages a 10% annual return. So like the stock market is like continuing to go up like over a really long period of time. Of course, we'll have like recessions and like as you see like if you guys invest, like they're kind of plummeting right now. Like the stocks aren't doing well, but like over a really long period of time, like it's like a 10% annual return. So like you're holding on for the long run and then you'll get back some money. And then we also have an index fund portfolio. So like index fund are also known as like mutual funds or like exchange traded funds. So it's basically someone choosing like a group of companies to like put into a singular stock, if that makes sense. So it's kind of like, you know how we said like diversification is super important. So it's kind of almost like putting diversification into a stock. So you have like all these separate companies, so you're not just like relying on one company to do super well. So it's like, and like that, like index fund, you'll see like, maybe one will like not do really well, but the rest will like do super well like that year. So that's kind of like, it's almost like a safer option. And so like famous index funds would be like Standard & Poor's 500 index. So like the S&P 500 is like usually like how people compare like how a stock is doing like and compare to like the rest of the market because it holds the largest like the largest companies, 500 largest companies. So it's like Apple and all like the recognizable stuff that are going to show you like how is the stock market doing like right now, like actuality compared to these like really large companies that have such big stakes in the game. So does that make sense? So it's like these index funds, they hold a bunch of different companies in one. Does that make sense? So you're not like the stock is like a regular stock is probably it's just gonna be one company. Like I'm gonna buy 100 stocks of Lululemon versus some known like ETFs, so it'd be like Spider, and they have like a lot of different like types of companies. So I'm not just like relying on one company to do super well. Instead, I'm like trusting whoever made that like ETF. Like, oh, like this is a lot of like cool companies, or this is based on a certain industry, which I think is going to do well. So I'm kind of relying heavily on the industry versus just a company. Does that make sense? Please ask as many questions as like you want. I know it's like so much information. I just want to make sure like I'm clear. Any questions? Okay, cool. More on index funds. Like I said, low risk since it's extremely diversified to match the market. So, your index funds are going to look like the S&P 500, which is like really showing a true indicator of how the market's doing. Index funds are generally considered ideal core portfolio holdings for retirement accounts, such as individual retirement accounts like our IRAs and 401k. So you're going to like put money. We talked a little bit about this. So when you're like putting money into your retirement account, you're not just like putting in money, you're putting in investments. So you're using the money in like that you're gonna like put in your retirements, and you're gonna invest in that. And a lot of people will invest in index funds because they are like a safer option and there's not a lot of risk that goes with it. Fund portfolio manager chooses which stock to add or subtract to the fund. They can also take a percentage of that total. So with index funds, like you're not going to be choosing like which stocks like go with the index fund. It's going to be someone else, and they're going to decide like what companies they think like will outperform like others, and like as a whole. And so they're just purchased like a regular stock or bond, but includes shares or like portions of shares of multiple stocks or bonds. And then index funds for every occasion. So there's like dog food companies, soccer ball companies, largest international stocks. So it's like there could be industry, it could be just like these huge companies that like aren't really liked, but you think they're all going to do well. There's every type of like index fund on both on Philly. So yeah, any questions on that? And then now we're gonna go into bonds, which is separate from stocks. So when you think of bonds, I usually think of like my grandma like buys bonds for me, and she'll like put them in like an account, and they'll get interest. So what is a bond? So an issuer, which is the company who's gonna give you the bonds, owes you a debt. So like you're gonna be basically loaning some money to like a company. At the end of the day, like that's kind of what a bond is. So you're purchasing like this singular bond or however many bonds for however much it costs. You're like, here's this money. It's similar to a stock. So it's like, here's this money, like take it, but you're in debt with me. So like when you make a loan to like a bank, you pay interest, right? And it's like at the end of the day, you're gonna pay more than like, say if you loan like $1,000, like based off your interest rate, you're gonna actuality like have to pay more than just the 100,000 like or 1,000 flat fee. So it's similar to like the bank or companies are asking you for a loan. So you're gonna give them money, and then over like a specific period of time, like interest will build, and then they'll pay you back like when they're ready. And you kind of set like that timing. So company needs the face value, so how much you're giving them to begin with, which is also known as principal, so just like some terms. And they will repay you with that face value plus interest in specific periods. So like how often you can pay, it's like quarterly, annually, etc. Until its maturity date, when you will get all of your money back. So you can like buy it like for 30 years. Like my grandma buys my like me bonds for like my birthday for like, you know, way down the line. I won't ever touch that money until it's like time to come, like until it's at its maturity, right? Because it's like has a you know specific interest, and like this interest like aren't that like high, especially when you're when you're doing the government. So these people are giving like the government offices money, and then at the maturity date and after maturity date, and they get the interest back, they're going to pay you what you gave them plus a little more. So it's like you investing, you're giving this amount of money and you hope to return some back. Like you will know like you are going to get some back. Like there's no losing, but interest rates can be like pretty low. So just continued on bonds. It's used by companies, states, sovereign governments to finance projects and operations when in need of financing. So just like when you need like help like buying a house, you're going to ask for a loan. Say a company is doing a huge project, or the government is like building something in your town, they're gonna ask you guys for loans, and like you can like buy it. Tend to be less risky since company will always have to pay off their lenders. The owners of the bonds are the debt holders of the issuer. Bonds have a time horizon from 1 month to 30 years. You can buy individual bonds or shares of a fund that include bonds. So like I said, funds include everything under the sun. So some of them are going to be bonds too, that makes sense. So how bonds make you money? Like we said, and we've touched on a lot, you'll get interest on bonds. So you're going to earn just a little bit back. So say you buy a 10-year bond from the government with a face value of 5,000% or $5,000. So you're giving this, so say you're giving the government $5,000. And they have a 4% annual interest rate. the government pays you 4% interest rate per year, so it's $200 per year. This, like at the end of that, the maturity rate after 10 years, you're gonna get $7,000 and therefore $2,000 profit just for giving them $5,000. It's not really doing anything. Yeah, and so you'll get the $2,000 profit plus the $5,000 that you lended them. And then aside from interest, you could also sell the bond for more than you paid. So generally when interest rates go down, bond prices go up. So you'll learn if you take like econ, if you're like a business major, you know about this. Well, you profit on this because now it is worth more than when you bought it. So like at that time, like interest rates are like, you know, they're at like, say they're like 5%. And then like a couple years down the line, you have this like, you have this bond that's like worth $5,000, but it doesn't mature till like 10 years. And now like the interest rate is like 2%. So you're gonna profit on this because it's worth more now than it was like later, because like just based on the economy. So you get more than like 5,000 back at the end of 10 years. So those are the two ways that you can make money off a bond. Yeah, and so just some alternative types of investments via, you know, we covered stocks, bonds, mutual funds, and ETFs, retirement plans. So our IRAs and your 401ks, you're putting investing into those. Also real estate, like buying a home, fixing it, and then you're selling it for more, like that's an investment. Options and annuities, and different bank products. There's a bunch of different types of investments. You just have to pick like which one's right for you. But yeah, any questions on that? I know it was a lot of information, but hopefully it was helpful. Yeah.
What if like a company you have a bond with like goes out of business?
It's a good question. I think they like, I don't really deal with my bonds, but I think they do have to pay you back. Maybe you want to look at it up?
Yeah, I can look it up.
Yeah.
Yeah, because I don't know. if
That's a
it's
good
really-
question.
It is. It says bondholders are more likely to receive or to recover their loss if the company files for bankruptcy than stockholders. So like the bonds are more.
Yeah. So it's like, they're kind
insured
of
in
like,
it, but
they're like binded to it, I think,
Mhm.
almost, because it's like, I don't know, like you can't just like get out of like paying a loan, right? So like they're still in debt to you. So like you're gonna be more likely to like receive it back, and that's why it's like kind of less risky. It's like a really risky company. But like stocks, like it's just gonna plummet, and so all the money that you put into your investment, like you're not gonna get that much out of. Like it's probably you're gonna lose in that sense. Yeah, that's a good question. I learned something from that. Yeah. Anything else? Okay, well, if you have any other questions, like feel free to come up to me after or like send me or Natalie a quick email. Yeah, just keep in touch. If you guys don't follow us on the Instagram, give us a follow. You guys are probably all in the hub and you guys go on the website. So yeah, thank you guys for coming. I hope you learned a little bit more about stocks and bonds. It was a really short meeting, but again, let me know if you have any questions after.
thank you.
Yeah.
Thank you.